Hi, my name is Josh. You may know that if you're receiving this video. However, you may not. It may be forwarded from somebody else. This video is a warning video, and it's basically what I'm doing is I'm sending out a message to warn people that the market is quite possibly going to have a severe drop here in the next 2 to 3 weeks, and you could save yourself a lot of money just by getting out, sitting in cash, or finding some alternate vehicles to invest in before this occurs. Okay, little personal history, so that you have some a little bit of basis of who I am and why I think this. I'm actually not a market guy, or I haven't been for a long time. I've been a real estate guy for the last 15 years, and I've done very well with that. We've owned and sold and still own quite a bit of property, and it is our livelihood. About a year ago, I got involved with a big real estate project, and not long after that, we were looking to sell out of that project, and we were going to have some cash, and couldn't find any real estate to put it in. So I started looking at the markets to try to figure out what I would do if I had to invest some money. And long and the short of it, I came across somebody. This guy's name is Simon Black. He has a company that I highly recommend if you're interested in these things. It's called sovereignman.com. You can find him on the internet very easily. And it's basically a personal freedom, liberty, and resilience information and opportunity company. Okay, I don't really have a good way to describe it, but anyhow, Simon kind of cued me onto the fact that what we have here is we have a real problem with our money, and it's not the first time. We have this fiat money, and what fiat money is, most of you probably already know this, but fiat money is paper money that doesn't actually have anything real that stands behind it. It has no intrinsic value. It has no value in and of itself. It only has the money that the government, or the value that the government says that it has. Fiat is Latin for "let it be done," right? So that has a lot of power if there's any integrity behind the statement of "let it be done." Well, there's no integrity behind our money, right? And this is ultimately the case with every fiat money that's ever been printed. They all go to zero. So it's very easily demonstrable. If I had a dollar bill here, I could just burn it and it would go to zero, right? Just like that, done. It's worth nothing. That's what all fiat money does. And you try to do that with real money, something that has real tangible value intrinsically, and it doesn't do that because it's not so easily destructible. The best representation of this are actual metal coins, right? Made out of metals that have intrinsic value like gold and silver. And there's other valuable metals as well, platinum and palladium. But those are the best examples. So our money is in sore shape. And as a result of the kind of the gross manipulation of the market via printing money and a couple other things I'll go into in a minute, the markets have quite a bit of built-up downside in them right now. And despite the best efforts of the Federal Reserve and the U.S. government, they're probably going to recapture that downside. They're going to rebalance, right? Anything that goes up has to come down. Ultimately, productivity increases, population base increases, these things, the markets can move up kind of over time, without ever having to get back to zero. But we're not in a balanced market state right now. So anyhow, the reasons this is going to happen. There's a severe credit crunch going on right now, particularly in the energy sector. So there's a lot of energy producing companies that are speculative companies that went out and borrowed a ton of money from banks, and they also went out and they raised a lot of capital via corporate bonds, aka junk bonds. And all of this capital is grossly underfunded because they were betting on $100 to $120 a barrel oil. And they have $30 to $38 to $40 barrel of oil right now, right? So they can break even, most of these guys, if they can get $60 to $80 a barrel, or at least survive. But right now their credit lines are maxed out. They have bond payments due, they have note payments due, they have payrolls to pay, and they're going broke. So that stuff's going to hit the market. And a credit crunch it really is the source of all market turmoil. whenever there's a market downturn, a really horrible one that lasts, a bear market, it's all about credit contraction. Credit rules the day. This is why banks have so much power. So this credit crunch is not really being talked about all that much right now, but it's out there and it's coming fast. Within the last week or two, some of the big boys that are playing in this arena, they've maxed out their lines of credit, right? And that's not good. So that's it. That's like their last line of defense against not going broke. There's their line of credit. Okay. What else? So the other thing that we're up against here is on March 31st, the deadline for withdrawals from retirement accounts, 401ks, and IRAs hits. And this happens every year, right? But this year is different because we have the first large statistical uptick in the baby boomers that are actually hitting their mandatory withdrawals. So we have a chunk of money that is required by law to come out of the markets. And most of those people, if you think about it logically, haven't done that yet because the market's been down since January 1st, right? So they're not wanting to sell anything and get out because they don't want to sell when it's down. They want it to recover. Well, it's not recovering, right? We have a nice little pullback now to about 2,000 that's mostly manipulated, right? That's been manipulated, and I'll go into the ways that's manipulated to this point. But so they're up against it. And today, the European Central Bank came out and said they were going negative, more negative with their interest rates, which is supposed to be stimulus, right, for Europe. Well, it's really bad for the dollar because that makes the dollar stronger and it makes our exports more expensive and their imports less expensive. So companies here in the United States now have less room to play in the world markets. And then to add, insult to injury, Janet Yellen's going to come out next week. And there's a good possibility she's going to raise rates and make the dollar even stronger, make it even harder for American businesses to compete. Now, is that good, sound, fundamental policy to raise interest rates? Oh, God. There's nothing about what's done right now in the markets relative to interest rates and central banks and quantitative easing and all of this stuff that sounded it's all bogus. So, that being said, would it be a good idea to raise interest rates? Maybe on some level because we need to rebalance, but it could hurt you a lot. So you need to be in cash. If for whatever reason more credit becomes available to businesses, particularly in the energy sector, they might be able to push this can down the road a little bit more. Now, I don't think that's going to happen. $40 a barrel, $35 a barrel oil, these oil prices, to a large degree, they're not controlled at all by the United States. Our storage capacity for oil is maxed out right now. Like, there's just nowhere to put it. They've been shutting down running rigs in the United States at a frightening rate in the last 3 months, right? At the beginning of this year, on December 31st, there were 689 rigs running. As of the end of February, there were only 480. It's like a 209 rig. It's like a 30% reduction in rigs running in the United States. That's a big deal. It's a lot of cash flow not going into these people that need to make these sizable debt payments, right? So not only they not make it, the price of oil is down, but they're not even pumping it because it doesn't even make sense to do that anymore. So I've seen this firsthand. I live in Texas. I live in an area that is on top of part of the shale play. And we saw the rigs come into town and drill holes all over the place, right? All these pumps going up, and now they're gone. They've been gone for a while. And, the rigs aren't pumping anymore. So you can just see it happening. I'm also involved with the mobile home business, and all of these oil companies, they've been selling these mobile homes they use out on rig sites to store their crews. En masse. You can just pick these things up for nothing right now because they don't need them anymore. There's actually a graveyard of a couple hundred of them a couple miles from me. This stuff is real. This is real happening. Like, they're not using that stuff because they don't need it, because they need to cut expenses everywhere they can. Okay, so what else is going on here? So the manipulation. Okay. The other thing. So there's kind of like there's a lot of weakness in the market right now, and it's going to be over the course of the next month or so. It's going to be discovered weakness, right? Because the earnings projections at the end of last year were really high, the earnings per share growth on in the S&P and on the broad index was expected to be 5% in quarter one. Now, this has just been revised within the last week by the company that does these things, and it's been revised down to negative 6.9% earnings per share growth. That's a huge difference, right? That's almost 12%. So that when those earnings announcements actually hit the street, those companies associated with them that those numbers are reflected in, they're all going to get hit really hard because that's a surprise, and the market doesn't like surprises. So these numbers may not be baked in yet because the actual earnings reports from the companies, just as the projections broad market have been announced, not the actual individual. Okay, so the market gets manipulated. How does it get manipulated? It gets manipulated by a couple things. The first one that most people don't know anything about is high-frequency trading. So high-frequency trading is computers that are set up at major banks and at major brokerage houses that can trade positions in the market up to 1 million times a second. 1 million times a second, right? And they actually front run too. So they get out in front and they put little feeler trades out there to see where trigger points are, stop points are for traders. And then they go and they trade really fast to manipulate up to those numbers to get those trigger points to trigger, and they manipulate and they use that in order to make money for themselves, right? So traders, to a large degree, have stopped putting these stops out there in the market for these computers to go find, right? Makes it harder for a trader to make money, but like, you know, if this stuff gets abused, you got to stop doing it. So high frequency trading, and that's a big deal. That's 80% of the volume. 80, right? That's huge. So high frequency trading, that's what's moving the markets nowadays. Okay, the other thing is that there's something that exists that you may know about, you may not know about, but it's called the President's Working Group on Capital. And the President's Working Group on Capital was Ronald Reagan's baby that he brought into existence after the stock market crash in 1983 because he didn't want that to happen again. It was kind of like identified as this like freak occurrence, and they were like, man, this would have been really great if we could have stopped this thing before we got really scared and the market tumbled out of control. So since then, like other things have been added, but the plunge protection team, or the President's Working Group on Capital, which has been nicknamed the plunge protection team to keep the market from plunging, plunge protection. A bunch of guys with no official title that have like a black box of money. And when things start to get out of control or they need to move the market in a certain direction, they just start buying things, right? So on some level, you might think to yourself, oh, it's great. They're going to kind of save us, right? Well, no, because they only have like a certain capacity to do that. They can't fund everybody's losses in a market that's a bear market that's being pushed upwards. It just doesn't work that way, right? They can't even make that much money. So, and in addition, like, where does that money come from? Well, it comes from you and me, right? That's what printing money does. It deflates, it inflates our money, so it's worth less. So they're stealing from us to prop the market up. And ultimately that money ends up going to the big boys too, because they know those guys exist. They actually like plan on the plunge protection team coming in and buying back so they can try to take some profits off the table. It's like, you know, it's common knowledge now at that level. So those two things are going on. And then what's also happened in the course of the last few weeks is because high frequency trading and the plunge protection team have been able to manipulate the markets up, professional traders got short a lot of things at the beginning of the year when they saw the market coming down. So when they get short, they sell things off. And with the anticipation of buying it back later at a cheaper price, right? They sell here and then they buy here. It's a little bit reverse than what you expect, buy here, sell here, but they still make the same profit, right? It's a fairly advanced technique that traders use. I mean, not really, it's basic in their repertoire. But what happens is that when they're expecting that to happen, and it does, but then things get manipulated back up, what happens? Their profit starts to go away, and eventually they get squeezed, right? Now they're losing money, and they've got to buy all that stuff back, and a lot of them, they're doing this on margin. So high risk for them of losing all of their capital if they don't buy back. So when this happens, when they're able to manipulate against short positions, then the short positions buy back into the market, and what do? They fuel the run, because they've got to actually buy the securities. So that's also been going on. So there's a lot of short buybacks going on, and that's been continuing to fuel this little bear market rally that we have going on. And it is a bear market rally. If I'm wrong about that, in 2 months' time will still be going up. So these things are going on, and that's how they've done this. That's how they managed to get this through. Next week there's going to be that announcement that by Janet Yellen. That could be a trigger point. What else is there? So that's really it. That's the bulk of the warning. I really would recommend that if you have the power to, if you're involved in the market in any way, just get into cash, right? That's the easiest thing to do. That's a sound investment decision, to be in cash. When there's a lot of volatility and you're afraid of what's going to happen, just get into cash. It's neutral, right? And in a time like right now, we may actually be experiencing a little bit of deflation. You may come out ahead. So please consider that if you think there's any validity of what I'm saying. The other things is that if you have a little more sophistication or you're willing to learn a little bit about it, you can short the markets, right? Not with a whole bunch of money, but with a little bit of money. Like get most of your money in cash, and then you can short the markets, right? You don't actually have to do it the way traders do it. You don't actually have to sell stocks anticipating to buy them back later. You can buy something called an inverse ETF. An inverse ETF does all the shorting for you. They go short, they bet on the market going down, and if it does, the ETF goes up, right? And they actually have these leveraged to 2 or 3 times, so you can, if the market goes down 10%, the ETF goes up 20. So, it's up to you. If you're interested in that stuff, I recommend going to tradermike.net, and he's got a list of all that stuff on there, and you can see what they are, and you can talk to your broker about it. If you run your own brokerage account, you can look them up. If you know anything about technical investing, I would strongly advise looking at the technicals of the market before getting into a position. If you don't, talk to your broker. Maybe they can help you. Okay, the last thing I want to talk about, this is probably the one that I would recommend the most, the strongest recommendation towards this. Although most people think, or a lot of people think it's a little bit hokey, and that's precious metals and precious metal associated companies and ETFs. For the long term, I recommend, that's not really the topic of this video, but I recommend actually buying some bullion of some kind. Buy some gold, buy some silver. Keep it on hand because it's a good hedge against inflation. And it's the real money. It's like the real stuff. It's non-destructible. It will not go to zero, right? It won't. So, and that's been proven for 4,000 years. It's not me saying that. That's just reality. Precious metal ETFs are also powerful right now. Gold miners ETFs and some of the gold income stream and the silver income stream ETFs. I really like RGLD, Royal Gold. I actually trade Royal Gold. I also like AEM, Agnico Eagle Mines. This is a really well-capitalized mining company that has dividends and is an excellent company. It has enormous upside over the course of the next couple of years. There's others. Franco-Nevada Mines is a pretty good company too. They just had an earnings report today. They actually overperformed, so that'll probably get a nice kick in price tomorrow on their share price. And there's other ETFs. So if you're interested in that stuff, there's knowledge, there's information out there. If you have some questions, you can send them my way. I'll answer them best I can. I'm not a professional market investor. I do trade in the market on a daily basis now. I have developed something of a skill for that after taking the last couple months to study it intensively and play with it a bit. And this happens to be a volatile time in the market, so you can do pretty good. And I'm taking advantage of that, and it's working. One more thing. I'm at 19 minutes, so I'm going to do this in 50 seconds. China is an outright disaster. Okay, and China can sink the entire ship. The world is betting on China pulling themselves out of this economic slowdown that they're in, but they're so overbuilt. They've spent so much money on things that they don't need that it's artificially inflated their market and our market and everybody's market to this point. So now they're in a place where they're cutting the reserve requirements of banks. They're putting capital controls on people. They actually control fund managers how much they're allowed to sell in an individual day because they don't want the market to go down anymore. They crank so much artificial money into their stock market, and it's not even working. There's mass flight of capital out of China. Everyone's trying to move their money out. So the Chinese government is trying to keep them from doing that. But people are clever. They figure it out, right? They're counted reserves of $4 trillion that they had just a year ago have been dwindled down by $1 trillion. They're losing money faster than they can generate exports. Their exports are down by a gross amount. Like, China is a disaster, and it's looming. And when it like really hits and it hits the streets, they're going to have to devalue their currency again. And you saw what happened in August when they did that last time. It really hurt our markets. So, I don't know if it's going to happen in the next 2 weeks, 3 weeks, 6 months, or a year and a half, but that's out there too. And they don't have a lot of rope left. Like, they've got to do something. Okay, that's it. So, any questions, please send them my way. Otherwise, if I upset you with this video, you probably need to be upset because this stuff's real. And I guess, I apologize for being the bearer of bad news, and hopefully I'm wrong. I don't think I am, but anyway, best of luck to you.